What if the same retirement dollar could get taxed twice? First, you pay regular income tax when the money comes out of a traditional IRA or old 401k. Then, if you miss one rule, take money at the wrong time, or fail to report it the right way, the IRS can pile on another tax. Not a warning letter, not a phone call, just a bigger bill. And here's the part that should get your attention. On a large retirement account, this can grow into a life-changing mistake. Not just $500, not just $5,000. I'm talking about a chain of penalties and taxes that can eat up $150,000 or more over a few years if nobody catches it. Most seniors never hear about this until after the damage is done. I started making these videos because someone in my own family almost made a mistake like this. She was doing her best, paid her bills on time, saved carefully, thought the hard part was over. But retirement tax rules changed around her, and nobody sat down and explained them in plain English. I make these videos so that doesn't happen to you. If this helps you, subscribe. I'll keep making them simple and free. Right now, there are probably two kinds of people watching this. The first person has been taking retirement withdrawals for years and assumes the tax side is already handled. They think, my broker sends forms, my bank sends statements, I'm probably fine. The second person just had a little scare, maybe a bigger tax bill, maybe a letter, maybe a friend told them they missed something. They want to know what to do before this gets worse. If you're either of these people, you're in the right place. Here's what most people never learn. The system is designed to do exactly what you tell it to do. Nothing more, nothing less. Nobody is checking if you took enough from the right account. Nobody is calling to remind you that one withdrawal made more of your Social Security taxable. Nobody is making sure a missed form gets corrected. It all falls on you. The good news is you can fix a lot of this once you understand the moving parts. I'm Daniel, and I've spent more than 20 years helping older adults understand retirement money in plain English. I've seen people lose thousands simply because nobody explained one rule at the right time. Over the next 20 minutes, I'm going to show you exactly what this double tax trap looks like, why it happens, and what you can do about it today. I'll give you real steps, real form names, and real websites you can use without getting lost. By the end, you'll know exactly what to check next. First thing you need to know is this. Your Social Security can quietly become taxable when other retirement money gets stacked on top of it. A lot of people hear Social Security and think it comes in tax-free. Sometimes it does, sometimes it doesn't. The part that catches people off guard is that the IRS looks at more than your Social Security check by itself. It looks at half of your Social Security, then adds in your other income. That can include pensions, IRA withdrawals, interest, dividends, and even capital gains. Here's a simple example. Let's say you receive $24,000 a year from Social Security. Half of that is $12,000. Now let's say you also pull $22,000 from a traditional IRA and earn $3,500 in bank interest and dividends. That puts you at $37,500 by the formula the IRS uses. If you're single, that is well above the $25,000 level where part of your Social Security may become taxable, and above the $34,000 level where up to 85% of your benefits may be taxable. That's where the first part of the double tax feeling comes in. You took money out of your IRA, and that withdrawal is taxable. But that same withdrawal can also make more of your Social Security taxable too. One move, two tax effects. That is why so many retirees say, I thought I was only taking out what I needed. Why did my tax bill jump so much? Now let's look at a married couple. Say the two of you receive $36,000 a year in Social Security combined. Half of that is $18,000. Add a $20,000 pension and a $15,000 IRA withdrawal, and now you're at $53,000. For married couples filing jointly, part of Social Security may be taxable above $32,000, and up to 85% may be taxable above $44,000. So a withdrawal that seemed harmless can change your whole tax picture. This matters even more after age 70 because many people start taking more from savings for home repairs, medical costs, family help, or rising everyday bills. You might think, I only needed an extra $10,000. But the real cost can be much higher once it pulls more of your Social Security into the taxable bucket. Here's what to do about this right now. Pull out last year's tax return and write down three numbers on one sheet of paper: your total Social Security, your pension income, and your IRA or 401k withdrawals. If you want help, sign in at ssa.gov/myaccount to see your Social Security tax form and check what came in. Start there today. Second thing, the biggest danger for many seniors is not a regular tax bill. It's missing your required minimum distribution and getting hit with an extra tax on money you should have taken out. This is the one that scares me the most because it happens to careful people, good people, organized people. A widow loses her husband and misses one account. A retired teacher has two old plans and thinks the bank handles both. A man moves money from one firm to another and assumes the new place has already fixed everything. Then the deadline passes. If you are old enough to have required minimum distributions from a traditional IRA or certain retirement plans, the IRS expects that money to come out on time. If you don't take any distributions or if you don't take enough, you may owe an excise tax of 25% on the amount that should have been taken out but wasn't. And if you fix it in time, that tax may be reduced to 10%, but you still need to act. Let me make that real. Suppose your required minimum distribution for the year was $20,000 and you missed it. A 25% excise tax on that missed amount is $5,000. That is not your normal income tax. That is an extra tax on top of the regular tax you may still owe when you finally take the money out. Now imagine a larger account. Say your required withdrawal was $64,000 and you missed it. The extra tax at 25% is $16,000. Miss it again on another account or miss it again the next year, and now you are looking at damage that can blow a hole straight through your savings. This is why the title of this video matters. The double tax isn't just a catchy phrase. It's what it feels like when the same retirement money gets one layer of normal income tax and another layer of penalty tax because the withdrawal rules were missed. And here is the part many people never hear until it's too late. If you miss the required minimum distribution, the fix is not to sit there and hope nobody notices. You may need to correct the withdrawal and file Form 5329. That form is how people report certain extra taxes on retirement accounts, and it is also part of how people ask for relief in some situations when they correct the problem. I want to say something important here. This mistake is common after a death in the family, after a move, after memory problems start, or after accounts get spread across several companies. So if you're watching this and feeling embarrassed, don't. This is not about being careless. This is about a system with too many moving parts. Are you still with me? Good. Let's keep going. Here's what to do about this right now. Make a list of every traditional IRA, old 401k, 403b, and similar retirement account you have. Put a check mark next to the ones that require a yearly withdrawal. If you missed one, call the company holding the account, ask what your required minimum distribution was, and then sit down with Form 5329 and Form 1040-SR or Form 1040 as soon as possible. Do that before this week is over. Third thing, even when you do take money out, the withholding is often too low, and that creates a second surprise later. This is where many retirees say, but tax was already taken out. Yes, sometimes it was, but not always enough. And when it's not enough, you can owe more at filing time. In some cases, you may even need estimated tax payments during the year. Think of it like this. You take a $40,000 withdrawal from an IRA for a roof, a used car, and some dental work. The account sends you the money. Maybe 10% was withheld. You think, fine, tax is handled. But then tax season comes and you discover that your real tax hit was much bigger because that withdrawal also pulled more of your Social Security into taxable income. Let's use numbers. Say you withdrew $40,000 and only $4,000 was withheld. Later, when everything is added together, your actual added tax from that move turns out to be $7,200. Now you are short $3,200. If this happened while you also missed a required distribution somewhere else, you can see how 1 year becomes a very expensive mess. This is how people fall into a chain. First, not enough withholding. Second, more taxable Social Security than expected. Third, a missed required withdrawal, or a form that never got filed. Each piece on its own may feel manageable. Together, they start to act like a trap. A lot of seniors think the fix is to wait until the next tax return and hope for the best. That is exactly what I do not want you to do. You want to catch this before the year closes, if possible. The earlier you act, the more choices you have. There is also one piece of good news for 2026 that many older adults should know. If you are 65 or older, there may be an extra deduction available for seniors. The amount can be $6,000 per eligible person, or up to $12,000 for a married couple if both qualify. But that benefit begins to phase out above $75,000 of modified adjusted gross income for single filers and above $150,000 for joint filers. In plain English, some people will get useful relief, but others will lose part of it because their income went too high. That means timing matters even more. So yes, one bad withdrawal plan can hurt you twice. It can raise your current tax bill and also reduce tax benefits you thought you were going to get. Don't forget to hit subscribe if you're finding this useful. The next one will be just like this. Here's what to do about this right now. Look at how much tax is coming out of your pension, Social Security, and IRA withdrawals. If it looks too low, don't guess. Go to irs.gov/form 1040 and review the current instructions, and if you need to send a payment, use irs.gov/payments. Handle that before the next withdrawal hits your bank account. Last thing, and this is the one that can turn into that $150,000 disaster. Large retirement accounts, multiple years, and one mistake repeated over and over. Let me give you the strongest example I can. Picture a widow named Carol, age 78. She has two traditional IRAs that together hold about $3.8 million because she and her husband saved for decades. After he dies, she is grieving, tired, and trying to manage paperwork alone. She thinks one account is on automatic withdrawals. It isn't. She misses a combined required minimum distribution of about $140,000 for the year. At a 25% excise tax, that missed amount creates a penalty of $35,000. Now pause there. That is not the end of the story. When she corrects the mistake and finally takes the money out, the withdrawal itself is still taxable as income. Depending on her total income, filing status, and the rest of her return, the regular income tax on that correction can be very large too. That same move can also make more of her Social Security taxable. Now let's say nobody catches it for another year because she assumes the tax preparer saw everything, and the tax preparer assumes the IRA company handled it. The next year, another misdistribution happens, maybe around $145,000. Now there's another penalty of more than $36,000. We are already above $71,000 in penalty taxes alone over 2 years. Add the regular income tax when the missed withdrawals are finally taken. Add the extra tax from more taxable Social Security. Add the stress, the scramble, the chance of paying late, and the cost of cleaning it up. Suddenly, a very ordinary retired person with a large account is staring at total damage that can move toward $150,000 faster than they ever imagined. That is why I want you to stop thinking about retirement taxes as something that only matters in April. For seniors, this is a full-year job. Not hard, not impossible. But it does need attention. And I want to say one more quiet truth. This problem often gets worse after one spouse dies, because the survivor may later file as single, and the income thresholds that affect Social Security taxation are lower than what a married couple used before. So the same kind of income can create a heavier tax result for the person left behind. That is why the year after a loss is one of the most important tax planning years of your life. Does this make sense so far? If something is unclear, keep watching. I'll explain it again in a different way. Here's what to do about this right now. If you have more than one retirement account, write the name of each account on paper, the company holding it, and whether a required minimum distribution was taken this year. Do not assume someone else handled it. Verify each one yourself or with a trusted helper today. Okay, you've made it this far. Most people don't. Let me give you two more things that work alongside everything I just explained. The first bonus is help, real help. Free help in many cases. If taxes make your head hurt, You do not have to do this alone at the kitchen table. There are programs that help older adults prepare returns and sort through retirement tax issues. Tax counseling for the elderly is one. There are also free preparation programs for qualifying taxpayers, and many older adults use AARP tax aid during filing season. The smartest thing you can do is bring an organized folder with your SSA 1099, your 1099-R forms from retirement withdrawals, your last tax return, and your questions written out in plain language. You're doing great. Most people click away by now. You're still here. That means you care about getting this right. Here's what to do about this right now. Put your tax papers in one envelope or folder tonight. Label it 2026 Tax Check. If you need help, use the free senior tax help options in your area before filing season gets crowded. The second bonus is a warning. Never assume the government, your broker, your bank, or your tax software is making sure you are getting the best outcome. These systems process information. They do not protect you from every costly choice. The computer only knows what got entered. It does not know that you forgot an old IRA at a different company. It does not know your spouse died this year. It does not know a withdrawal for a furnace also pushed your Social Security into a higher taxable range. I remember when I first learned this, it changed how I thought about the whole situation. Stay with me, there's more. Here's what to do about this right now. Create a simple one-page retirement tax list with 5 lines: Social Security, pension, IRA withdrawals, required minimum distributions, and taxes already withheld. Keep that paper with your checkbook or bill folder so you see it every month. So let me make this simple. What I just showed you is how one retirement move can trigger more than one tax problem at the same time. The reason it matters is that these mistakes do not stay small. A missed required withdrawal, low withholding, or one bad timing decision can cost you thousands, and on a large account, it can snowball into something devastating. The action you need to take is one full review of your retirement income, your withdrawals, and your required minimum distributions. That's it. One step. Do it today. If you only remember one thing from this video, remember this. Retirement taxes are not automatic just because money is coming in and forms are showing up in the mail. You still need a simple plan. Check what came in, check what went out, check what was withheld, check whether every required withdrawal was taken, and if something was missed, fix it fast. One thing before you leave this page. Think of one person in your life who needs to hear this. Maybe it's your brother, maybe it's your neighbor, maybe it's someone from church who keeps saying, I hope my taxes are okay. Send them this video. One share could protect someone from a mistake they never saw coming. That's all I'm asking. Next time, I'm going to show you how one small Social Security filing choice can quietly change your monthly income for years. Most people never learn about it until the paperwork is already done. I'll see you then.